What's going on, guys? Welcome back to the channel. Here in this video, we have to talk about two very important things. The NSCC is going to be issuing automatic margin calls. We're seeing some crazy new announcements that we have to go over here on this channel. But secondly, I do first off want to start off this video talking about the fake squeeze. And it's kind of funny because every time AMC goes up 20% in a single day, 10% in a single day, you start hearing these comments in YouTube sections, pretty much everywhere else. So those are the two things we're really going to talk about here in this video. Hit the like button for me, consider subscribing to the channel. Let me know in the comment section what do you guys think about all of this information. By doing all three of those things, you help push this video out to as many people as possible that need to hear this information, and this information is crazy. So first off, let's talk about the fake squeeze, this whole fake squeeze concept. And from what I believe is the fake squeeze is that essentially AMC is going to go up, it's going to look like a squeeze, and everybody's going to hold the stock because we think it's going to go to $10 billion, and then the stock's going to plummet straight back down. We're never going to see a short squeeze ever again. That's simply not the case. We have never seen a short squeeze with AMC stock, and when we do short squeeze, the sky is literally the limit. Look out your window, look at the sky. That's the limit up there. Maybe Pluto, maybe Mars, who cares? The point is, we're going to make massive tendies. We already know this. But why am I saying, or at least I'm going to say, AMC has never short squeezed yet? There has never been a short squeeze in the history of AMC, and that is a bold claim that I want to talk about right fucking now, because this is pissing me off. January and in June, these were not short squeezes. I don't know where this concept is coming from of a short squeeze when a short squeeze has never happened before. It's never happened. Take a look at the Ortex data, the exchange reported short interest data for, let's go right before the June rally, because people would argue this was the short squeeze, the only short squeeze of AMC. These shills, these naysayers in the comment section, that's what they're going to say. That's why they say a fake squeeze is coming. Beware of the fake squeeze. We know the trade for one. But on the second hand, take a look at, let's go May 28th, the settlement day for the exchange reported short interest data. We were at 19.93% short interest of the free float. Okay, 2 days later, we started to go crazy. We actually seen a down day, May 28th, on the stock of about 3%. Fast forward, June 30th, after the short squeeze had happened, AMC was chilling between $50 and $60 per share. The short interest went to a whopping 14.71%. This is not a short squeeze. A 5% decrease in the short interest is not the MOAS. And what I want to be very clear right here is that the community today is much stronger than it was back in June. We can argue about this all day long. This is a given fact. We have seen time for the traders to get out of this, the apes that weren't really apes to begin with, that were in this for a quick couple week momentum trade. They're out of the stock. They have been out of the stock, specifically since the stock went from $45 down to $20 per share. If you were somebody that did not believe in this movement, you got out. Likely, when the stock started falling from 60 down to 45, but specifically the volume tells us that people got out of the stock back here in the 45 to the $20 range. People sold out that were not in this for the actual MOAS. So all in all, add these together, the community has never been stronger today, and the short squeeze has never happened. A short squeeze with AMC has quite literally never happened until the short interest is reported by the exchange reported data right here on Ortex, this whole column right here, until it's reported to be at, say, Facebook short interest at 1% or 2%, 3% even possibly. The MOAS has not happened, and don't settle for that bullshit, because that's just a load of shit that people are saying in the comment sections everywhere. Be careful of the fake squeeze. I don't care if we go to $300, $400, $500, $1,000, $5,000. If the short interest does not come in at 1, 2, 3%, I'm not selling my stock. I don't care. The short squeeze has not happened until this happens, until the short interest looks like Facebook. It's not happened. So that's really the concept of the whole fake squeeze. What it is, if you guys are unfamiliar, That's what it is. Share price going up. People think it's the short squeeze. They hold on to their stock, comes back down. Say $100, $200 per share, and then people are stuck holding the bag. These are really the naysayers, and that's what I want to point out here in the beginning of this video. And I think that is very important to point out, as we are going to see more FUD come into the stock as the stock price does go up. Because to break it to you guys, some people, even if they believe in AMC, they just don't want to see other people making money. They don't want to see the massive wealth creation trade that is here on the table, and they don't want to see that come to fruition. So what's the best thing the average shill can do? Comment in the comment section. Let you know how they feel on Twitter. Even the news, right? They're the biggest shills ever. They're going to say all they want. But the main argument, keep this in mind, the main argument from naysayers of the AMC MOAS back in January and in June was, hey, the days to cover are so low. Half a day to cover. The shorts cannot be squeezed out of their short positions. Well, that is true. That's a different story today. Totally different ballpark we were playing in, with the days to cover being at yearly all-time highs. And I want to point this out because I want to point this out in all the videos that I make recently, or, you know, in the next couple of weeks, right? Or until we see this proven wrong. The days to cover is the leading indicator of the MOAS, or a significant short squeeze. You guys can see right here, short interest, days to cover high, share price down, share price goes up, days to cover goes down. That's exactly what we seen before the June rally and the January rally. Days to cover at 2.4. We peaked at, jeez, I got bad heartburn. Days to cover at about 2.4 days to cover back January 5th, 2021. What happened? Share price was at $1.90. Share price went up 10x. Days to cover shot straight down. Stayed at these lower levels. Days to cover started to creep back up to about 1.72 days to cover at the peak, May 11th, before the June rally. And the June rally hit. Stock price went up 10x. Days to cover fell down to 0.5 days to cover. Now the days to cover has been ever so increasing, almost on a daily basis. We haven't really seen any major downticks to the days to cover. Now we're at 2.54 days to cover, and the stock price has been going down as the days to cover has been going up. But now what we've seen on Friday, the days to cover has actually ticked down and the stock has went up. So watch for this correlation. And basically what I'm trying to say here, pay attention to the data. And the data right now is in our favor with the short interest at all-time highs. No way to say this. There's no way to sugarcoat this. The days to cover, short interest, not the share utilization, but the sentiment of the ape community is at all-time highs. You can't tell me otherwise. You can't make an argument in the comment section if you're a naysayer or a shill of the AMC MOAS. These are facts. The data is here. And the data does support the MOAS that we are saying. Believe it or not, love it or hate it, I don't really care. I'm holding my shares. I know 4 million other apes, maybe less than that, since most of them have gotten squeezed out, are holding on to their stock. That's all that matters. And that's what I'll continue to say here on this channel. Now, I got a little ticked off in the beginning of this video. I'm going to try to cool it down a little bit. Now I want to go over the margin calls that are going to be coming for the hedge funds, and basically the NSCC that is going to be issuing these margin calls. This is a new proposed rule change that we must go over here on this channel. This is SR NSCC 2021-016. As we can see right here, NSCC's capital requirements for its members has not been updated in over 20 years. Since that time, there has been significant changes to the financial markets that warrant NSCC revisiting its capital requirements. For example, the regulatory environment within the NSCC and its board members operate has undergone various changes. The implementation of the Basel III standards, the designation of many banks as systematically important by the Financial Stability Board, as well as the designation of NSCC as a systematically important financial market utility by the Financial Stability Oversight Council, have significantly increased the regulatory requirements, including capital requirements for many financial institutions and CCPs. The covered clearing agency standards adopted by the Securities and Exchange Commission have raised the regulatory standards applicable to CCPs such as NSCC. If we skip down to page 12, this is 1,300 pages long. By all means, feel free to read this. I'm not saying don't read this. We're sure as hell not going to read this all here in this video. We're just going to point out the main points that you need to know. So it says right here, members, U.S. broker-dealers. NSCC proposes increasing minimum excess net capital requirements for members that are U.S. broker-dealers using a tiered approach. These increases would be between 2 and 10 times the current minimum excess net capital requirements applicable to members that are U.S. broker-dealers, depending on whether the member self-clears or clears for others, and its VAR tier as described below. As described below, NSCC proposes to use in general terms calculations from its value at risk VAR model and associated member charges as a measure of market risk in order to categorize members into those that pose relatively minimum risk exposure, moderate risk exposure, and higher risk exposure to NSCC. Unlike the current capital requirements applicable to registered broker-dealers, the proposed enhanced capital requirements for U.S. broker-dealers would result in those members whose NSCC activity poses greater risk to NSCC being required to have and maintain greater levels of excess net capital in line with the increased risk. As in the case of the current capital requirements applicable to registered broker-dealers, the enhanced capital requirements for U.S. broker-dealers would depend on whether a member self-clears or clears for others. A broker-dealer that clears transactions for others has the potential to present different and greater risk to NSCC than a broker-dealer that clears transactions only for itself, and is therefore appropriate for such broker-dealers to be subject to heightened capital requirements versus a broker-dealer that clears transactions only for itself. Citadel would be an example. They are a market maker as well, so they clear transactions for other people. So they're going to be seeing increased basically collateral or margin obligations to their margin accounts, and this is coming at a very bad time for everyone involved, for hedge funds in general, because we know the hedge funds need to see the pressure for us to see the MOS, and pressure comes in two forms: by regulation and rule changes like we see right now with NSCC, DTCC, as well as the SEC that have been happening over the past year, but are becoming even more aggressive, like this new proposed rule change 016 that we are seeing from NSCC. That's going to add even more pressure to the hedge funds. But also, if you're not heavily concentrated in the 15 stocks or so that are your big cap stocks, your big tech stocks like Facebook, Amazon, Microsoft, Google, if you're not heavily concentrated in those, you're taking significant losses at the current moment as small caps and mid cap stocks are getting shorted into the ground. So it looks inevitable. From all the data that we are looking at, forget the naysayers, the MOAS is coming here very, very shortly. So if you guys like this video, if you guys get helpful information out of it or like the insight, just want to help share this video with as many people as possible, hit the like button for me, consider subscribing to the channel. Let me know in the comment section, what do you guys think about this information? What do you think about Citadel getting margin called, potentially getting margin called? It's very interesting. I think they're going to get margin called. Let me know what you guys think. What is your take on that down below in the comment section of this video? At the same time, check out the link in the description for public, as well as the links pinned in the pinned comment down below. Follow me on Twitter, that is free 99, as well as the links for the buy and sell alerts if you guys want to be notified every time I buy or sell stock, options, and or crypto. Love and appreciate you guys. Thanks for watching this video. Enjoy the rest of your Sunday, and I will see you in the next one.